Hello, and thanks for tuning in to another episode of the MarketMinder Minute. The Fed has been in the news the last few months, and many investors are likely worried a rate hike might mean poor stock returns ahead. However, history shows stocks returns are just fine following an initial rate hike. In our view, fears of a Fed rate hike pulling the punch bowl from the party too soon are misguided. As my boss, Ken Fisher, likes to say, fear of a false factor is a powerful thing, and these fears build the wall of worry bull markets love to climb. Historically, world stock returns following initial Fed rate hikes 6, 12, and even 18 months later are overwhelmingly positive. In our view, there's little to suggest this time will be any different. Further, looking at the 6 bull markets since 1970, all lasted over a year after the Fed's first move. In fact, the average length of a bull after an initial hike is around 3 years, with plenty of robust bull market returns still left. So historically, the initial rate hikes haven't been problematic. But trouble can arise if the Fed overshoots, inverting or flattening the yield curve and choking lending. With a fairly wide spread between overnight and 10-year interest rates today, one rate hike is unlikely to materially impact the yield spread. Also, rate hikes aren't irreversible. An initial hike or even increases don't mean tightening must continue. The 82 to 87 and 90s bulls saw a series of rate hikes turn to cuts, and cuts back to hikes, all while stocks rose. We don't encourage confidence in Fed officials' abilities, but assuming one hike means steadily rising rates is wrong. For investors, the takeaway should be to ignore the fear-mongering. The sooner the Fed hikes, the sooner markets climb over the fear and up the wall of worry. Don't fear the hike when it happens, cheer it. That's all for this installment of the MarketMinder Minute. For more, please visit marketminder.com, and thanks for watching.